Shares of Coforge rise over 1% as the management in a conference call says it expects the Encora deal to be EPS accretive by FY27.
The Defence Acquisition Council will meet today to mull purchases worth 80,000 crore rupees. Defence stocks rise.
Metals are the top sectoral gainers today as prices surge across the board. Hindustan Zinc rises as the silver prices rally, as well as copper prices too hit record high.
Shares of Timex slip as the promoter launches an OFS to sell 9% stake at a floor price of 275 rupees a share. This will be the second such stake sale by the promoter and will reduce its holding to 51%.
Shares of Seagull India surge as it wins a 1,089 crore rupees project from the Madhya Pradesh Road Development Corporation. Hello, good morning. You've tuned into Chartbusters, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, and with me is my colleague Ekta Batra as well. Ekta, good morning to you as well. While Nifty implied open indicated a stronger positive start, we started a bit on that positive side, but again, a dull day coming in for the markets today as well. Nifty 26,000 right now, it's what is holding on to. Whether this sustains through the week, are we going to be seeing a sideways move? Given, obviously, it's New Year's. So most of the people are on holiday, but we'll keep an eye out on the volumes also through the day.
Hi, Vinny. Yes, absolutely. It's a quiet session and it generally is towards the end of the year. We've seen this take place for multiple years, but when we do come back and when volumes start picking up, we can expect that Jan 5th onwards. It will be the run-up to the budget. So we will expect a lot of news flow as well as the earnings season, which will be kicking off for Q3. So that's when really the queues will start picking up. But as of now, just about consolidating, just about buying time as we speak. So the Nifty just about lower by around 25 odd points. Let's welcome Shivangi Sarda from Motilal Oswal Financial Services for a technical check on the market. Shivangi, hi, welcome to the show. Thanks very much for taking the time out and season's greetings to you. If you could just start by giving us, what your call would be on the index, considering that it's so range-bound and quiet.
A very good morning, Vinny and Ekta. Thank you for having me. Of course, it's the last week of 2025, and it's a good time to reflect on the entire year, including our portfolios. Now, talking about the markets, the market have been consolidating in a quite tight range. Of course, we've seen some slight profit booking at the higher levels with a lack of follow-up buying at any small attempts of recovery. But the good part is that the support levels are intact, and we are seeing 26,000 level act as a sticky zone for the index. So 26,000 would be important to watch out for. If it fails to hold these levels, then we could see some downside towards 25,900. But then again, downside, doesn't really look quite grave from these levels because of the quite solid support-based buying that we have been seeing. Of course, put-call ratio has sunk a little in the last two trading sessions. But overall, we will have to factor in the fact that India VIX is at a single-digit level, and which is causing some sort of slack in the entire broader market. So 26,000, an important level to watch out for the next up move towards 26,200 with the set support. Now, if we talk about the Bank Nifty index, of course, this has been an outperformer throughout the year with PSUs, outperforming. Bank Nifty has also been consolidating, but the good part is that it is holding to the support of 58,700 marks. So that would be an important support to watch out for the next upside towards 59,500. But then again, we would see some staggered movement. Of course, volatility within a small range expected because of the monthly expiry tomorrow.
Okay, surely we'll keep an eye out on that volatility given that it's monthly expiry. But Shivangi, good morning. Which are the individual stocks that you're keeping an eye out on as well?
Many individual stocks, first up on my radar is MCX. Of course, all the exchange-related counters are looking quite positive and all the disclosures applied. But the kind of movement that we've seen in the metal in the last few weeks has been tremendous. And of course, silver has been outshining. But apart from that, copper and the other metal pack are also showing a lot of good momentum, which is why MCX is soaring high. It is trading in a lifetime high territory, but then again, we've seen that volumes from the last 1 week have been significantly higher with the price action confirming the move as well. The participation is intact even at the lifetime high levels. And we are expecting this momentum to continue. So recommending a buy here with the next target of 11,600 and a support of 10,900 marks for MCX. And the second pick on my radar is Tata Steel. We've seen this stock has seen a good amount of short covering move recently, and this is coming out of its 50 daily exponential moving averages. Year-on-year basis as well, the stock has actually performed quite well with over 25% return on a YTD basis. Overall, IVs have cooled down, so which is indicating a comfortable buy here at these levels with the next target of 180 levels and a support of 170 zones.
Okay, all right. We're going to let you go on that note, Shivangi. Thanks very much for joining in and taking us through all of those calls. Let's shift focus now to our special segment where we get you a few ideas for profit from Money Control Pro. Khushbu Rai Gupta of moneycontrol.com joins in now to talk about the stocks that she's tracking very closely this morning. Khushbu, over to you.
In today's idea for profit, we are recommending Hindustan Unilever. HUL is a market leader in the FMCG space with a strong presence in home care, beauty and personal care categories. The quarterly results of the company were largely on expected lines, and we feel that there are multiple triggers for stock upside and the valuation also looks reasonable. The company has laid out plans of strategic investment in the emerging demand drivers and also predicts margins to improve after the ice cream business demerger. For the food business, HUL will pivot the portfolio towards high-growth food condiments categories and will focus on market-leading tea brands given the deflation in the tea prices. On the premium push, HUL will increase its focus on growing the under-penetrated liquid variants in the laundry and dishwashing space and also leverage e-commerce channel to grow these segments. It has also indicated early signs of urban demand recovery, which will drive growth in the coming period. While the margin pressure may persist in the near term, the company will take price hikes which will keep margins steady.
Thank you so much for that, Khushbu. But on that note, we're actually going to slip into a very short break. But after the break, we'll get you more stock-specific action, more talk on the market. Stay tuned in for that.
Welcome back. You're still tuned into Chartbusters on CNBC-TV18. Well, it's turning out to be a very quiet day, but we're seeing a lot of traction in the metal stocks. So we have Tata Steel, which is up around 2.5%. We have ONGC, which is not doing too badly today, so up around 1% for ONGC from the oil and gas space. And on the downside, just watch out for a couple of these stocks such as Adani Ports, HCL Tech, Reliance, which is seeing a little bit of a downtick in today's trade. But overall, you'd have to say it's an extremely quiet market at this point in time. The street just about biding away time in the last week of the year. But how has auto demand played out in the month of December after a month of strong sales in November? Sudarshan is here with an analysis of the Vahan data. So over to you.
So it looks like that for auto companies, what they have got into high gear after the GST cut announcement. It seems that they are going to end the year of 2025 on a high note. If you go by the Vahan registration data, it's indicating a strong momentum even in the month of December, especially for four-wheelers. Both passenger vehicles and the commercial vehicle segment are set to see the growth either in high single-digit or double-digit growth, while for two-wheeler, the growth is expected to be in mid-single-digit. So for total registrations so far as per Vahan website, basically as of December of 28, registration has increased by 9%. with two-wheeler registration rising by 4%. For PV, it's up 15%, CV 16%, and one standout has been three-wheeler, which has seen registration rising by almost 16%. If we talk about the company-wise in the two-wheeler space, the biggest outperformers remain as usual. TVS Motor and Eicher Motors, the biggest underperformer Hero MotoCorp, which is likely to lose the market share of more than 500 basis points. And the second underperformer is Bajaj Auto. If you talk about the four-wheeler segment, both Mahindra and Mahindra Auto segment and Maruti are expected to report a healthy set of numbers for the month of December. Even Tata Motors passenger vehicle segment, passenger vehicles is expected to report a growth of more than 10%. If you talk about the commercial vehicle segment, for the last few months, both the two companies, Tata Motors as well as Ashok Leyland, have been seeing a strong performance, and in the month of December also both the companies may report growth of more than 14%. Come to the electric two-wheelers. Ather Energy is likely to see a growth of more than 40%, while for Ola Electric, it's going to be another month of underperformance where it might see a decline in the registration of almost 50%. So overall, it's going to be a strong month of December for the entire segment except Ola Electric.
Okay, all right. Thanks very much for that, Sudarshan. So that's on the auto space. But just watch out for L&T, where they bagged orders in the range of 1,000 to 2,500 crores for Hyderabad Greenfield Radial Road project. So that stock is in focus on account of that particular order win. But the big stock which has dominated headlines in the past weekend, you'd have to say, is Coforge, which has pulled off what is its boldest move yet. As CNBC-TV18 reported, it has agreed to acquire US-based Encora for $2.35 billion, creating a combined entity with $2.5 billion in terms of revenues and ambitions to play in the big league of AI, product engineering and cloud-led services. Let's listen in to what the management had to say about the acquisition themselves.
The acquisition of Encora is a defining moment for our organization. And I mean a defining moment. Born in the Silicon Valley, California, Encora is one of the select technology services firms with an AI native DNA that provides software engineering services for digital native companies and Fortune 1000 enterprises. Encora works at the convergence of AI, cloud, data, with service offerings that span intelligent process design, agent-native product engineering, core modernization, AI foundation, data readiness, and AI ops.
From financials perspective, the consolidated turnover of Encora Group for financial year 26, the estimated number, and they follow April to March financial year. So estimated number for financial year 26, revenues are around $600 million and adjusted EBITDA of the firm is 19%. With Encora's current margin profile and the anticipated synergies that we see in the business, and the combined business is expected to operate an EBIT margin of 14% post amortization of intangibles that will be created as part of the purchase price allocation for this acquisition. Despite the primary infusion, the deal is not expected to be EPS dilutive on a consolidated basis because of the strong margin profile of Encora and expected synergies from the two businesses, that is Coforge and Encora, coming together.
This will reposition Coforge as a player with scaled up nearshore delivery capability in LATAM, with an exceptional engineering and AI talent base servicing US clients. Encora has a large and widespread nearshore delivery capability with more than 3,100 delivery team strength in its LATAM delivery centers. It will significantly expand the West and the Midwest US client footprint of Coforge. Pre-acquisition, as you know, only 25% of Coforge's North America geo unit revenue came from the US West and Midwest. This acquisition will provide a fillip to Coforge's North America growth plans. Coforge's North America business is expected to jump by around 50% to $1.4 billion post-acquisition. The combined firm will now have 45 $10 million plus highly scalable relationships.
Okay, that is about Coforge. Nifty, as of now, also just a quick take at that because it's just at 26,000. It went slightly below 26,000 as well. So let's watch out for that one. As of now, Nifty is trading at the day's lowest point for y'all. But talking about Titan, that stock is something that we're keeping an eye out on in the last couple of trading sessions. The company has entered into the lab-grown diamond jewelry market with Beyond, which is their brand, and the first retail store is opening in Mumbai today. So Darshan is here now to tell us what the brokerages are making of this and what is it that it means for Titan. So Darshan, over to you.
So Titan was averse to entering into lab-grown diamond business if you talk about 12 to 18 months ago. But finally, the company has announced its foray into lab-grown diamond business and it has named it Beyond. Now, the two brokerage notes are there, Morgan Stanley and Citi, and two contrasting notes. Morgan Stanley maintains overweight call with a target price of 4,062 per share. It believes that this step is in the right direction. It will help overall diamond business that Titan is into. But Citi maintains neutral call with a target price of more than 4,100 per share. It says this announcement that company has entered into lab-grown diamond business has come as a negative surprise, and it does not expect Beyond to drive any meaningful growth or earnings for the company. And this foray may pose risk as it signals its admission of LGD's, basically lab-grown diamond business, being a threat to natural diamond business that company is already into. So two contrasting notes, but overall it's being taken positively.
Okay, all right. So Darshan, thanks very much for that. So definitely catching up there in terms of lab-grown diamonds, Titan and focus. In fact, the management also told CNBC-TV18 over the weekend that they have been actively studying consumers in this category for the last 2 years. They say in India, there is a place for both natural as well as lab-grown diamonds to potentially expand the studded jewelry market. The management adds natural diamond jewelry continues to grow for their brands in healthy double digits and seeing an emerging need of consumers who wish to buy affordable lab-grown diamond studded jewelry for everyday fashion wear. On the brand Beyond, they say it is positioned as design-led lifestyle fashion jewelry brand and will have a no exchange policy for LGD stones, with most products priced under 1 lakh rupees. So that's on Titan. Definitely a big market emerging there, Vinny. But on that note, we need to take a short break. We'll get you more on the markets. A lot of stocks in focus on the other side. Stay tuned.
Welcome back and thanks for staying tuned into Chartbusters on CNBC-TV18. While the Nifty is just around the 26,000 mark, only metal sector is managing to hold on to gain today. But we're going to pivot and talk about the cement sector. 2025 was a pivotal year for the cement industry, which saw significant consolidation. But growth in demand could not keep pace with the expansion in capacity. Will 2026 bring good tidings for the cement industry? Let's go across to Nigel and find out all about that. Nigel, over to you.
2026 could be a crucial year for the cement sector. The big question is whether the early green shoots in demand will strengthen or they'll fade away. Well, cement demand remained weak during October and November 2025, and growth during these 2 months was roughly around 6 to around 6.5% on a year-on-year basis. This compares with around 5.5 to around 6% growth that we saw in the first half of the fiscal. The slowdown was driven by 3 big factors. First, the sluggish government capital expenditure. Second, labor migration linked to the Bihar elections. And third, there were curbs on construction activity, particularly in the NCR region, due to the pollution-related restrictions. Birla Corp spoke to us here on CNBC-TV18, and they said that while demand was sluggish in October and November, early signs of improvement have started to emerge in December. The street is hopeful that demand will see an uptick in the fourth quarter of this fiscal that could be supported by higher government spending. Well, there was some pricing discipline and prices remained resilient between April to August 2025. However, the average pan-India prices declined by around 2 to around 2.5% in October as well as November, That compares with the average pricing that we saw in the second quarter of the fiscal. The impact was sharper in the non-trade segment, with prices falling by roughly around 15 to around 20 rupees per bag across regions, while trade pricing was softer by close to around 5 rupees per bag. The question now is whether a meaningful price hike can only be absorbed post the quarter 4 FY26. Well, consolidation in the sector appears to be largely behind us. The top 5 players account for around 62% of the industry, up from around 51% in 2020, and the share could rise to around 65% by 2028. However, the challenge is that the recently acquired assets are getting ramped up, which could lead to additional supply. In fact, the supply risk continues as capacity additions are expected to grow at a CAGR of around 7.5% to around 8%, while demand growth could be in the vicinity of around 6.5% to around 7%. This suggests that utilization levels will stay sub 70% for a prolonged period. And as large players continue to chase market share, mid-cap regional players may face greater pressure on pricing as well as on profitability. According to DAM Capital, large cement players are better positioned due to their diversified regional presence, the ability to gain market share without significantly affecting their profitability, and capacity to sustain capex momentum. They expect competitive intensity to remain elevated, benefiting large players over the medium term. Well, let's wind this down with a valuation snapshot of all our listed players. So 2026 is shaping up to be yet another important year for cement stocks. Whether green shoots on the demand front they blossom or they wither away, that will depend on the pace of the government spending, pricing discipline, and how supply additions are absorbed.
Okay, all right, Nigel. Thanks very much for that. On that note, we need to wrap up on Chartbusters with the news that the markets are absolutely flat, just about consolidating. We have Trading Hour up next with all of the top stories.